Good morning, everyone, and welcome to today's webinar on fix and flip loans. Everything you need to know to finance your next fix and flip project. Now, as questions come up during the webinar, feel free to go ahead and use the questions function. We want this to be as engaging for you as possible. So if you have any questions during the webinar, please go ahead and use that function, and we will ask them as they come up. With that, I want to turn it over to today's speakers. Take it away, Jim.
Hello, Rose, and thank you, Rose. Good morning or good afternoon, wherever you fine folks might happen to be here in the United States. I'm Jim, been with this company since its inception in 2015. So I'll be talking today a little bit, and we'll let Darren do most of the talking because he's younger than me, so he's sharper.
Exactly.
Okay. What's the next slide say? The about us, I'm not going to spend much time on this. We had 4 offices. We'd make loans in 49 of 50 states. So we can do fix and flip loans in any of those states and or ground up construction loans. We won't talk about the management team because we've been here too long, but we do get along after all these years. So my question is, and I know they're not able to answer, I wonder how many folks on the call have actually done a fix and flip. I won't be able to get the answer, but
well, if you guys want to answer the question, you can just put it in the questions thing, and I'll let him know.
Cool.
Mm-hmm.
Well, I'm going to assume that this group hasn't done a lot of fix and flip loans, but it's a big market, and that slide talks about why is it such a big market. Well, it boils down to one thing: ROI, return on investment. We'll share a couple of examples of how these investors that find these properties that need repairs, and due to the age of homes in America, due to that age of homes, there is a lot of inventory that needs a lot of work. So it's a huge market of homes that need work and improvements. Investors find them, they buy them for X, and they sell them for Y, and the goal is Y must exceed X. And they're doing that. The average return on these things is something like 30%. Next slide. 30.2% profit. And that's been growing over the years. So people are getting smarter about doing this and how to manage a project. Fix and flip business and ground up for sale properties is all about managing the project and the timelines, along with the budget. Exceeding the budget on these will bite into your profits. Next slide. Here's a property we recently did a fix and flip loan on in Bellevue, Kentucky, which is across the river from Cincinnati. Know the town well. The house on the left is before the repairs. The inside of this house went from very ugly to very nice. This investor just paid us off recently. Bought it for $175 January this year. 9 months later, sells it for $430.
It's a pretty good deal.
He spent $100,000 on repairs. Actually exceeded his budget by $15,000. But you think he made any money, Darren?
Yeah, it looked like he doubled his money, if not more. That's a great deal.
He did well. What's the next slide say?
Now we have a question from Jason. He wants to know, do we have to use a licensed contractor, or can we do the rehab work ourselves? I'm pretty handy.
We allow self-performing work for people that have verified experience, and we can see from their track record they've done this in the past. So on very large deals where we're getting involved in $700,000, $800,000 budgets, repair budgets of that size and magnitude, we require licensed contractors. But that's not the average deal. The average deal is I'm buying it for $200. I'm going to put $50,000 in it and sell it for $400. That one can be done by the investor himself with limited contractor experience.
Yeah, and then some states actually have specific rules to that. They have laws that you actually have to use a contractor no matter what the size. So it's definitely state specific as well. So just keep that in mind.
Good question. Okay. That picture there is that's that same house in Bellevue, Kentucky. Old kitchen, new kitchen. Of course, you can see the wow factor there. It's a little bit different today than it was when he bought it in January. Next slide. Here's what we call a partial midterm construction stall situation. And we specialize in these because a lot of the lenders in this space don't like the stall deals. That house on the left with the Tyvek wrapping is when we first seen the loan, and the investor builder, this guy had built 12 homes. I think this was up in New Hampshire. Basically ran out of funds. But when he bought the lot and he framed this home, he's $400,000 in and comes to us for a loan to finish the project. We approved it, he got the project finished, and it was so nice that this builder's wife said, this is one of the finest and cleanest homes. She called it pretty. It was so nice that she said, we're going to buy it. Now that's a problem for us in the sense that we don't do owner occupied properties. That's the finished house or almost finished. So they had to apply for a loan with us. We made him a 30-year fixed based on his bank statements, his self-employed business. So we collected 24 months of bank statements and turned that into a 30-year loan. So midterm construction stall turned into a permanent loan. We look at those, many others don't. What do you think, Darren?
Yeah, it's a great niche that we offer. Take over properties like this, mid-construction, and then we could actually, just the investor could do 2 loans with us and we could put them into what's called the DSCR deal, which we'll get into later in the presentation.
Guys, Shannon wants to know, do you only do single family homes?
Go ahead, Darren.
Yeah, no, that's a good question. We will lend up to 4 units, and case by case, we might even go up to 8 units if the strategy is to refinance it into a DSCR deal and not just a fix and flip it. We might be able to do 5 to 8 unit as well.
What is a DSCR loan? That's a follow-up from Shannon again.
Yeah, so we're going to get into that later in the slides, but it stands for debt service coverage ratio. And it's pretty much just the market rents have to cover what your mortgage payment, your PITI is on the loan. But again, we'll dive deeper into that towards the end of this presentation.
Okay, great. Show me the money.
One more example. That's the house this is in New Orleans. The before on the left at 330, sold it for 740. That picture in the middle is a little distorted. The house isn't quite that tall, but it was a complete remodel. And another one where he actually exceeded the budget. I think he was about a $200,000 spend on this. That interior of that house was a total wreck. Involved some water issues that we had to remediate. But anyway, at the end of the deal, 530 in, 740 out. Just goes to show what one can make on these properties.
That's a really pretty property.
Good returns. Program overview. Darren, I'll let you take that one for starters.
Sure. So just a brief introduction of myself as well. My name is Darren Samarel. I have been in the lending space over 20 years. I have been specializing in fix and flip lending for the past 3, but I'm also a real estate investor myself. So I do fix and flips. I have a few buy and holds as well. So we really know, we have a large knowledge base of what it takes to get these deals done. So just a program overview, we definitely want you to have an LLC to take these deals down because they are business purpose loans. You could talk to your tax professional. Obviously, that's not us about setting up an LLC. Few things we don't do. We do not lend on commercial properties or mixed use. So if you have any buildings where there's like 4 apartment buildings upstairs, but there's an auto dealership or something downstairs, we don't lend on that. That's not our cup of tea. We will do first-time home buyers for fix and flip projects that have no flip experience. So we do specialize in that, and a lot of other clients, a lot of other lenders will not let you do that. But obviously lower leverage on those because they're riskier deals, but we do accept first-time investors, not first-time home buyers, sorry. We'll go through the application process in a little bit, but it's a very easy application from us. It's not a TRID loan, so there's no 1003 involved, and we'll go through that in the next couple of slides.
No 1003. I like that, Darren. No 1003.
Yeah, the 1003 is most of the process when you're doing a regular loan. It takes forever to fill that thing out. And then we don't look at your income as well because these are strictly business purpose loans. So no income evaluation necessary.
No
Darren,
DTI.
Nope, you do not. We do not calculate a DTI, a debt to income ratio. That's for sure.
okay, guys, Brendan wants to know, is there a minimum experience level of the general contractor?
Yes, so we usually want to see that the general contractor has done deals in the past for sure. And if they're licensed and the project is small enough, then we should be okay with that, right, Jimbo?
Yeah, so we talk about cosmetic makeover where I've found a house down the street from where I live and it's basically paint, carpet, new doors, new granite. That one wouldn't require a lot of experience, but if we've got say we got a large property, 4,000 square feet, somewhere in northern Massachusetts, the home was built in 1899, and it's a $750,000 spend. That contractor will be vetted for his experience, because that's a large project, time consuming, and when the onion skin comes off as you start tearing the house apart, we call it the gut job when you gut the property, the demo period, lots of things pop up and the expenses, the budget can get out of hand in a hurry. So those require very experienced contractors. But let's talk about the guy that's I'll call myself Jimmy Lunch Bucket Voizard. And I live at 383 Weston Road in Troy, Ohio. There's a house down the street that I've seen deteriorate over the years and now it's for sale and I want to buy it. I've never done a construction, fix and flip loan in my life. All I've seen is what's on TV, flipping Las Vegas, and I watch that at midnight. But I want to buy this house. I don't have any experience. So Darren, as a first-time investor, how are you going to help me out? What can I borrow?
Yeah, so it's going to depend on some things, right? And that's what this slide is perfect for. I mean, usually we'll go up to maybe 65, 70% of the what's called loan to cost, and that's the purchase price plus the rehab included. So we want to see that they have a lot more skin in the game because they're not experienced. But because these aren't regular loans and we're not looking at your income, we're not looking at 1003s like we were talking about. The main consideration is going to be the project and obviously the location itself, right? We want nice areas where these deals will flip for a profit and that they're in good neighborhoods. And we just want to make sure you guys hear it all the time, location, 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 right? When it comes to real estate. But for fix and flip, it's even more important because it all depends on the actual property itself and the project. We're not going to look at your income, even if you're a first-time flipper, but we do look at your assets. We want to make sure that you have money in the bank, at least 6 months of payments that you could cover during the actual job that's going on, right? But we also want to make sure that you have enough for the down payment. And it varies depending on your experience level, what the down payment is going to be. So that has to be covered as well as the actual some of the rehab budget. Again, we call it skin in the game. So, and then we do still pull a credit report. That's one thing that we have to do on every client. And we could go as low as 60 on some deals. And I've seen it even lower than that, but those are for lower leverage deals where you're bringing in a lot of money and experience to the table. So, and again,
So
go ahead, Jim.
my deal here in Troy, Ohio is $200,000. I got about 100 grand to my name. That's all I have. That's my life savings after 20 years. I got to pay 200 for the house and it's going to cost 50 to fix it. So on that 200 purchase price, how much can I borrow if I got, good credit? 720. Of the 200, how much can you lend me?
Are you the first time flipper?
Yes, I'm Jimmy Lunch Bucket first time.
Okay, so usually we're max on those 70, I'd say 70 to 75%.
So 150 grand.
Correct, roughly.
Now,
I don't have the calculator.
The $50,000 to repair it. How much of that can I get?
You're going to get 70% of that as well.
7 times, so 35,000.
Correct. So that's what we call loan to cost. You just combine those two. You do 70% of the purchase price, 70% of the rehab budget, and combine those two, and that's your total loan amount.
Okay, got it.
Next slide, please. Okay, so like we spoke about a couple of times briefly though, experience is huge in fix and flip. You don't need the experience, but then you're getting the max 70% like we just talked about. If you have a ton of experience and good credit and good assets, we go as high as 85% of the purchase price and possibly even 100% of the rehab budget. The 100% is definitely case by case, and we're going to want to see that you've done at least 7+ flips in the last 2 to 3 years. So we say roughly 30 months, about 2.5 years. So experience is definitely a huge motivating factor of what we look at to actually approve these deals and how much we're going to lend you. So anything to add on that, Jimbo?
Yes. That second bullet, do we understand the financial side of the fix and flip? Very important to know when you get involved with beginners or first timers, second timers, older homes. Perfect example of where we saw a deal fall apart and the investor made no money, got out even. Older home, back to my Troy, Ohio deal. The house was built in 1960, has city services, so sewer at the street. When they got into the property and the repairs, they've discovered that the toilets weren't flushing properly. They get involved into, why is that not working? Get a plumber out there. The line's plugged up. We call it the lateral that runs from the house out to the street. It's shot because the 80-year-old trees the roots have just destroyed this lateral line out to the street. So we got a major issue. We got to dig up the line and put in a new one. That's not $1,000 or $2,000. That's major construction because now you're talking about heavy equipment to dig up this dirt, go through the sidewalk. When to get to the street where it connects to the city services, that's deteriorated as well. Can't get a permit until we actually buy all the parts for the end of the line to hook into the city. Now you're calling up people to dig up the road, tear out the asphalt, and reconnect at the street. $100,000 later, he had himself a house where the toilets would now flush. His profit on the deal was $100,000. It all went to that one mistake, that one thing. So that's what we mean by, do you understand the financial risk? What they didn't do up front, an experienced guy would do this on an old house. They're going to put a scope in that pipe before they close the deal. They're going to look at that lateral line to see if it's working or not working. That little inspection cost $150. So rookies don't do that. Experienced people, they know what they're doing.
Yeah, and just to summarize that in a nutshell, we call it flip economics. So we want to see that, there's going to be a decent profit that you're making from this deal. If you're buying and you're actually borrowing from us 200,000 and you're going to flip it and just sell it for 210, 220, that's probably not going to fly with us. So we definitely want to see this flip economics and that the deal makes sense.
Ground up construction on, so this is new builds. Sometimes they're actually sometimes it's easier to build a new house than to fix a very old home. But we started in this financing side of the business of financing ground ups about earlier this year. When a builder contacts us about financing a new build, we have 4 early on questions and we need 4 yes answers. I'll go off of memory. The first question we ask is, do you have a buildable lot approved by the city or the county? If that's a yes, we go to the next question. At this buildable lot are all services at the curb, meaning electricity, water, and a heating source. If that's a yes, we move to the next question. How many new builds have you done in your life? 0, this is my first one. Well, we couldn't help you if you have no experience. We look for 3 experiences before we can approve a ground up loan. And the last question is financing construction of a new home. Those loans have always been done by the banks across the United States. When a bank won't make a builder a loan to build a new house, we ask them, why won't they? Simply because our interest rate on this kind of a loan is going to be, call it 10%. Banks do these at 7 or 8% construction loans. So they're here for a reason. The bank didn't get it done. We asked them, what was the issue? Many times we find out it's something like, I bought this lot 3 years ago for $300,000 took the money out of the bank, and now I need to borrow 150 of that back to get the project started. And the bank says, well, we don't lend money cash out on land loans, so you can't get any of that money back. So it's a lack of assets that they decide to hold against the borrower. At LendSure, we'll give you $150,000 of your 300 back the day we close the loan, so you can start the project. Meaning, I'm now going to compress the ground, get the land ready, and pour my foundation. So that's a niche for us. I don't want to get too deep into this. It's probably new to you guys, but if you run into a scenario where a builder wants to build a home on spec or build a home to rent out, we will look at those loans as long as it's not owner occupied. Again, this is a business purpose only loan, so there's no TRID, no 1003s, and no income. So these are builders primarily building on spec.
Jim, Pedro wants to know, can I get pre-qualified to shop for lots to build on?
Yeah, we can clear the credit and the assets to be sure those parameters are met. But the critical piece here would be location. Location, Darren mentioned it. Location in the fix and flip world is very important. So before we get too far down the line on that, we're going to ask them what part of the world you're looking to build a house in. But yeah, we can clear the equity, we can clear the credit, we can clear the experience.
Okay, and then we have a mortgage broker on the line. He actually works with us, Brendan, and he says, you stated this is not a TRID loan. Without an IRLA, so would our NMLS license be involved on the application? That leads me to believe we could lend in other states where your firm may not lend.
State by state on that one. The application that we do use is an online app at our LendSure website. So it's not a 1003, but you still fill out an application. The first part of that's going to, if you're a broker, a mortgage broker, or a mortgage licensed loan officer, it's going to ask you who you work for, address, and your license number. If you don't have a license in that state, we have a list here from our legal folks of where we can allow that loan to go forward and where we can't. Is that right, Darren?
That is correct.
Okay.
And we could share that. We could share that list.
Fantastic.
Okay, so I'm not going to spend much more time on construction loans other than to tell you there's two parts to it. That's day one loan and then the draws. As the project goes along, we fork money over to the builder so he can keep the project moving. But it's a lend money out as the project goes forward.
Okay, I got another question on ground up construction. Can you do this as a one-time close where it includes the cost to acquire the lot in the total loan amount?
We can look at that. If the borrower's funds aren't adequate to pay for the lot, then that's going to lower the amount of loan that we can make.
Okay.
It's just going to be a smaller loan because of the lack of owning a lot free and clear.
Got it.
There you go, Darren. That one's for you.
Yep. So to simplify our process from beginning to you guys getting your actual money to start your project, this is really it. Our application is pretty simple. We could probably even share it in the link. But if you just go to lendsure.com and click on fix and flip, it'll take you to our application. It's a series of questions, but I would say for an expert, it'll take about 3 minutes to fill out. For a newbie, about 5 minutes. So it does not take long at all. Then we will review your application. We'll do our due diligence and look at the property and scope out some comps. And then we'll provide what's called the term sheet. And the term sheet's going to have all the terms of the deals, your interest rates, the points charged, and all the fees needed to close the deal. Once you guys as investors sign that term sheet and send it back to us with some other documentation, then we will submit it to our underwriting team. Typically underwriting's anywhere from 24 to 48 hours tops, and we'll get you guys a loan approval with all the conditions that have to be met to get our clear to close. Once you guys send us those conditions in, we get our clear to close, and then the funding takes place. Typically, it's about a 21-day process, but we've closed them as quick as about 10 to 14 days as well, just depending on how fast we could get the appraisal and the conditions in. We could get these done within 2 to 3 weeks tops.
So on that close time to get one of these completed and funded, a lot of that is based on the builder, the investor, the contractor. One thing they're good at is building homes, fixing homes, getting to Home Depot, getting what they need, getting materials there, and getting the job done. What they're not so good at is paperwork. So typically we
Correct.
find pulling all those conditions, which in most cases our conditional loan approval would have 10 to 12 conditions. It's not a lot, but sometimes it's hard to get all 12 from folks that build homes and repair homes. This paperwork's not what they do. But if they're on their game, Darren said it, we can close in 15 days.
Yeah. Okay. And a lot of those conditions are just title and appraisal stuff that the investor doesn't really have to worry about. But yeah, this is what I see that holds up the deals the most, are exactly like Jim just said, the paperwork, the scope of work, just stuff like that that we need from the investor or builder right away.
Okay, and I've got a couple of people asking me, yes, I am going to send a copy of the slide deck to everybody who registered. So look for an email in about an hour from me, Rose Waldy, and that is going to have a link to the recording of the webinar that you can feel free to share, as well as a copy of the slide deck. And I'll make sure to include the application link as well, so you guys don't have to worry about writing it down.
Hey, there's conditions
there. Yeah, these are just usually the conditions we ask for. Like we talked about, when you send the term sheet in, this is what we're looking to get it to our underwriting department. So obviously a purchase contract, the scope of work, we usually like to see that before it goes to underwriting, just so we know the details of the project. And then simple stuff, your driver's license, a couple of months of bank statements to show that you have the assets in there. And then we provide the flip experience form where you just put your past projects, and then we'll do our due diligence to verify that you have actually done those projects. So pretty simple process for the conditions.
Okay. Hey, we didn't put the tri-merge on there. You got to add the credit to that list.
Yeah. Jim, you want to talk about the draw process briefly?
Disbursement of funds. So on a fix and flip, if the purchase price is 200 and we lend you 120 on day one, a $40,000 rehab. None of that $40,000 to rehab the house is lent out on the day of closing. All they're going to get is the 120 to buy the house. They're going to bring in their $30,000 down payment. The 40,000 is what we call holdback, and that's dispersed after we verify through a third-party entity. They come to the property and say, "Oh yeah, the roof's on the house. The new roof is done properly, and it costs $22,000 to do the roof." That would then authorize a disbursement of the funds towards that 40 grand. The next 18,000 or whatever it is, 20,000 would come later as the project moves towards completion. So bear in mind, no construction funds are dispersed day of closing.
And then, yeah, just some of our strengths that we were talking about that a lot of our competitors don't do. We spoke previously about the mid-construction stall. So if you guys ever have a deal where you just, for some reason, couldn't finish the project, bring those to us. We wanted to take a look at them. We will do the first-time investors as well. Definitely do heavy construction projects, just need to show the experience like we talked about, and how much leverage is actually needed on those deals. And then here's where we could get really creative. Some of the deals that we've done for past clients, we could actually, our fees, say we charge 2 points, just to use as an example, we could charge one of them up front when we close, and then one of them down the road when you're actually done with the project, and either sell it or flip it, or I'm sorry, refi it into a long-term loan. So we could charge the second point there. We also have the ability to actually stack payments for the right borrowers, meaning if you close the loan with us, we could put 3 to 4 payments on top of your loan amount. So for the first 4 months of your project, you don't have a payment to us, which is huge, because a lot of our investors could actually finish these projects in that time span without even having to worry about paying us until they actually sell the property. So that's a great strategy that we get very creative with.
Hey, Darren, those last two bullet points are genuine market niches for us that hardly anybody will consider. Can't say everybody, but a lot of folks will not split the cost of the origination fee, as Darren mentioned. So that's talking about capital. When you go to close this loan and start the project, the investor has nothing going on in his life except managing the project and writing checks. He's paying taxes. He or she's paying utility bills. He or she's paying contractors. He or she's going to Home Depot buying materials. It's one thing after another. It's check, 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 and there's no income. There's nothing's coming in. It's all going out. So when we can lower the cost of closing, that's valuable funds that the investor can keep in his pocket. On top of that, when you're in the throes of repairing this property, it's, we close the loan on November 1st and January 1st, you're into it, and you're just paying and paying and paying. The last thing you want to face is a $6,000, $5,000, depending on the loan size, interest-only payment to LendSure. Then February 1st comes quick, and you got to make another $5,000 payment. Stacking or including those 4 payments into the loan amount, so they don't have to worry about it, keeps that 20,000 bucks in their pocket versus our pocket. Huge niche when you're dealing with people that don't have $1 billion, and not everybody in the world has $1 billion. So those are 2 great points to always think about when you think about fix and flip. Who do I go to? The answer is you go to Darren Samarel at LendSure.
Exactly. Okay, let's talk about your guys' exit strategy. So obviously, there's only 2 of them. You either sell the house, collect all your profit, or if you're a buy and hold investor, you're going to refinance it into that DSCR loan that we talked about, and we will do that loan for you as well. And the great part is we all already have a after repair value appraisal done, so we could usually use that new appraised value without any seasoning if you're refinancing into a DSCR deal with us. A lot of lenders will have like a 6-month seasoning requirement, meaning that you have to, after you've done the improvements, you've had to have the deal for 6 months more to use a new appraised value. But if you're doing the loan with us, that's not the case. So that's another niche sell for us. Next slide, please. Yep. So we'll just get more into, if you're doing the buy and hold strategy, the DSCR deal is kind of perfect for you. You do not, again, it's a business purpose loan, so you do not have to show income. We're just qualifying the rental income that will come in off that property versus what your PITI mortgage payment is going to be. And that stands for principal, interest, taxes, and insurance. And I guess HOA, if there's an HOA on it too. So you just combine that payment. Say your monthly payment for your mortgage is $2,500 a month. As long as your market rents in the area cover that $2,500 a month on a 1-to-1 basis, you have decent credit, you'll qualify up to a certain amount, usually 85% loan to value on purchases and about 75% on cash out and 80% on rate and term refinances. So a lot of our investors, instead of flipping the property, decide to hold them, and they just refinance it into a DSCR deal, which is great because you just come right back to us and we will do that loan for you as well.
So investors buying to rent think about one thing, and it's 2 words. They think about cash flow. Wish I had a $100 bill, I'd show it to you. But cash flow. So DSCR, debt service coverage ratio, the debt versus the payment. I look at it as, can the house's rent, whatever this house happens to rent for, let's say that's $3,000, I can rent for $3,000. Does that cover my payment and my expenses? Thinking about cash flow, like who wants to have a $3,000 payment and I'm going to rent it out for $2,000? That'd be $1,000. That'd be $1,000 loss every month. So the key to this one is passive income, cash flow. Is it positive or negative? When people want to buy a house and it turns out to be a negative cash flow, we're like, tell me how bad you want to lose money. Like, how much do you want to lose before you say, I'm tired of losing money? So it's all about cash flow. And these are easy loans to do because there's no income requirements. It's just, what's the house rent for? What's your credit score? It's 20% down. Let's close.
Yep. And this slide just represents what we were talking about. Don't get confused with the equations here, but does your rent cover your mortgage payment? That's all this one's saying. And I'll actually, can you go back real quick? So just at the
Sure.
bottom of that slide, I will talk to that a little bit. It doesn't mean that we won't do the deal if it's less than 1%. It's just usually higher interest rates and lower LTVs, lower leverage on them. So, don't let that discourage you if that's happening in your deal. We could still probably get those done depending on the deal.
Okay, I've got a question about what about if you have units, like let's say a 3-unit, you have one that's vacant. Does that calculate into the current DSCR? How does that calculate?
Yeah, so if you bought the property from us to fix it up and then you're going to flip it into a DSCR, then we'll use the market rents in that area. So the appraiser goes out and does what's called the 1007 and just finds all the market rents that other 3 units are renting for in that area. And then we'll use that number to calculate out your DSCR ratio.
Yeah, we're going to assume all 3 units will be rented. Highest and best use.
Correct. And this just goes through some of the guidelines for our DSCR product. Again, up to 85% on purchases and 75 on cash out. I think we do 80% on rate and term now. We just got that approved a couple of months ago. We could go up to 1.5 million, but we've seen them even higher than that. Those, you just have to be careful with the DSCR ratio because, the mortgage payment typically is going to be high on larger loan amounts like that. But there's ways around that, like short-term rentals or Airbnb. We could use income such as that as well for qualifying DSCR deals. So we could finance up to 10 properties for one investor, which is great. And we could qualify you on an interest-only payment, which is huge. So if we're just doing the interest only, we'll take that payment and use that against your market rents for the DSCR ratio. So not a lot of lenders does that as well. So yep, next slide.
And I could speak to this one a little bit. If you go to www.lenddscr.com, we built this calculator for property investors. Basically, you just go in step by step, enter bits of information, and on the right-hand side, it's going to, like, let's say it's prepay or monthly rents. On the right-hand side, it will tell you exactly why we're asking for it, so that you can go around and say, okay, well, what if I change the prepay, or what if I change the loan amount, or change the value, or change the monthly rents? How does that affect my rate? It's a really handy tool. And if you play around with it and you say, okay, you know what, this is what I'm comfortable with, you just click submit, send it over to us. It's that simple and easy. So I do encourage you to go to lenddscr.com and play around with that tool. I think you will like it. And it's very educational too. We built it so that somebody who's like a first-time investor just wants to learn about what it takes to get one of these loans, it's going to guide you step by step and educate you throughout the way until you're completely comfortable with the program.
Hey Rose, yesterday when I filled that one out when you were over here, I was actually able to navigate through that and complete it myself, and I have 0 technical skills.
I can vouch for that.
What I mean is like I learned in 2015 that there's a right click on a mouse. It's been 5 years to know there's a right click.
I've seen them type too. It's painful.
we made it a very simple process. Great tool for rookie investors.
All right, so questions. Let's get to any if you have any final questions, guys, please go ahead and use it. Use the questions function, and I will ask the speakers for it. Can you guys lend on larger family projects, 5 units or more?
Yeah, so typically our bread and butter is just 1 to 4 units. And speaking with some people at the company, we do have 5 to 8 unit DSCR programs. So if the end use case is to flip it into a DSCR deal, then we could possibly go 5 to 8. for a fix and flip project, but our bread and butter is 1 to 4 units.
Hey, Darren, I got a question. Please inform this great group of people how to reach you. What is your phone number?
My cell phone number is 619-384-7605. And I'm sure Rose will send out an email and share my information with you guys as well.
Thank you for reminding me. I will add that into the follow-up email that you guys get in about an hour.
Thank you. But yeah, contact me anytime with questions about fix and flip or DSCR deals.
Darren works 7 to 7. He's a 12-hour guy.
Yes, sir.
7 to 7.
I've got a question here. Can we use our contractor's experience as our own when qualifying?
It's a good question.
Depends on
Yep.
the size of the deal. Talk about the construction, Darren.
Yeah, no, I think Jim touched on this earlier as well. It really depends on the size of the deal. It depends on what state it is, because some states have different rules about having to use a licensed contractor. And you can even get creative with some of these deals. I've seen people partner up with their contractors and start their own LLC and do it together and both be on the loan. So there's definitely ways to do that without, there's definitely ways to use your contractor's experience depending on the project and your experience level as well.
Okay. Are there any prepayment penalties on fix and flip loans?
Nope, that's the best part about these. These are either 12 months or possibly 18 for ground up construction, but no, there's no penalties. So if you start a project and you fix it and flip it within 2 months, you're not going to get a penalty. They're business purpose loans, so no prepays.
Forgive me, I'm not quite understanding this question, but can you guys cross collateralize? I'm not sure what that means.
I can take that one on. So that's a deal where the numbers don't quite foot on the project itself. In other words, it may not look like it's showing enough profit. It's a risky deal for both us and the investor, but the investor believes that it's so hard, so well that he's going to get his number. To make the loan work, we will put a lien on one of his 10 real estate holders. Let's say he owns 10 properties. They're all rented. One of them's free and clear. It's worth $200,000. So we'll put a lien on the house, which is the fix and flip, and a lien on one of the rentals, thereby shoring up the loan and letting the investor close versus not close.
Okay. And I think this looks like it's the last question. If you guys have more, please go ahead and use the questions tool. Can you guys lend up to 100% of the rehab cost?
On a case-by-case basis, yes. We like to see high credit score on that, a lot of past experience for the investor. And yeah, we're just going to verify. Usually like to see, at least 5 projects within the last 30 months to get to that 100% of the rehab covered.
Okay, great. Well, if any other questions come up, please go ahead and just reply to the email that you guys are going to get in about an hour. That has the recording, that has the slide deck, that has all this great stuff. And just reply to it. It'll come to me, Rose Waldy, and I will get that answered for you. Or you can contact Darren directly. I'll include his email address into that. So with that, Jim, Darren, any parting words?
Nope, just feel free to reach out to me anytime, and we look forward to working with you guys and funding your next fix and flip project.
Cool. Jim, any last words?
Where's the best place to find an investor that wants to do this? Call your local realtors in town. Realtors know investors.
You sure do.
All right. With that, thank you so much, everybody, for joining us.
Thanks, guys.
Thank you.
Thanks.